Welcome back to the Deep Dive. Today we are strapping ourselves into the control room of the global markets. And it's a fascinating, sometimes frustrating place to be right now.
It really is. The whole mood is what you could call event-driven plus cautious positioning.
Exactly. So our mission today is synthesis. We're going to take all the sources, everything compiled as of December 23rd, 2025, and just distill the core drivers for you.
And right now, it feels like everything is being filtered through two monumental forces. On one hand, you have central bank liquidity, the deep technical stuff.
And on the other,
high stakes geopolitical and tech risks. The kind of thing that can move an entire sector overnight.
Okay, let's jump right in. We have to start with the foundation, with liquidity. You really can't talk about the market today without talking about the signals from the central banks.
Especially the New York Fed.
Absolutely. If you're trying to grasp what's moving short-term rates, you have to start right there.
And that means we start with the New York Fed's reserve management purchases, or RMP. That's the acronym you're hearing everywhere in the fixed income world.
So for anyone who doesn't spend their day reading Fed minutes, what exactly is RMP? And why is it suddenly the core management tool? Is this just quantitative easing with a new name?
That's the million-dollar question, and it's a critical distinction. The Fed's implementation note says RMP is to supplement reserves, to stabilize the short end of the market.
So it's about making sure the plumbing is working.
Exactly. Think of it less like QE, which is, this aggressive tool to stimulate the economy and expand the balance sheet in a huge way. RMP is more like, well, technical housekeeping.
Housekeeping with a pretty massive immediate impact, though.
Oh, absolutely.
Yeah.
The initial plan we're seeing in the sources is for about $40 billion in short-term security purchases just in the first month.
So the market is watching that rhythm.
It's the definitive tool right now for short-term liquidity and overnight rates. When the Fed buys, it ejects cash. And the whole point is to keep those borrowing costs stable and predictable. It's managed. It's deliberate.
Okay, so that RMP pulse is our baseline. It's preventing any, sudden disasters and short-term reserves. But let's zoom out. What about the broader interest rate environment?
The rates themselves are still pretty firm. They're not signaling any kind of panic easing.
What are the numbers looking like?
The benchmark U.S. 10-year Treasury is hovering around 4.16%. The 2-year is about 3.50%.
So if you're a business, the cost of borrowing is still pretty expensive. This doesn't scream massive rate cuts are coming.
Not at all. And that stability, it ties directly into the Fed's messaging. They keep saying, yes, inflation is gradually falling, which is good.
But it's still above that 2% target.
Yeah.
And employment is holding steady.
Which forces them into this gradual and cautious approach. They're being so careful with the timing, the magnitude of any potential cuts. The caution is everything. They don't want to declare victory too early.
Now, here's where it gets a little counterintuitive for me. If the Fed is injecting, $40 billion in liquidity through RMP, you'd normally expect the U.S. dollar to weaken a bit, right?
It would. More dollars floating around should mean a lower value.
But we're not seeing a big collapse in the dollar. That
is the crucial observation. The U.S. dollar index, the DXY, it's been pretty firm, oscillating around, say, 98.1 to 98.7.
So why is it so firm?
Well, you have to look outside the U.S. It suggests a couple of things are happening. First, a bit of a global capital flight. Investors are parking money in dollar assets because they see less stability elsewhere.
So the dollar is strong by comparison. It's the best house on a shaky block.
Exactly. So that relative stability, combined with the firm yields and the RMP, it's all keeping the market in this very defensive posture. It creates this uncertainty about where capital should even go next.
And you see that defensiveness reflected in the broad indices, right?
Immediately. You look at something like VOO, the Vanguard S&P 500 ETF. It's near $626, but it's just stuck in this tight defensive range, maybe $620 to $635. It's not running away.
The caution is palpable.
It is. And the VIX is sitting around 16, 17, which, isn't panic, but it shows traders are not complacent. They are very sensitive to news.
Which is the perfect transition. Since the Fed has kind of managed away the short-term rate volatility, traders are looking elsewhere for risk.
And that focus lands squarely on single-stock geopolitical uncertainties.
Which brings us to the biggest event driver outside the Fed, NVIDIA. This is just dominating the entire tech conversation.
The NVDA H200 export saga is where that liquidity-driven calm meets, well, geopolitical fire. The stock's in the $470, $480 range, but its next move hinges almost entirely on one thing.
Regulatory certainty.
Total regulatory certainty around exporting its new H200 chips to China.
So break down that uncertainty for us. Why is this specific chip so critical?
The H200 is seen as essential for the next leap in advanced AI, and multiple reports are confirming that a U.S. review is underway. There are even whispers that regulators might be leaning toward approval. But the devil is in the details. What are the conditions? The volume limits? And crucially for NVIDIA, who within China can actually buy it? And for what purpose?
So they might get a green light, but with so many restrictions, it doesn't even matter from a revenue standpoint. And you have Congress getting involved now, too.
Correct. Congress is demanding to see the licensing review process. It just adds another layer of political scrutiny. Our sources are saying this is the single largest catalyst and risk for the entire semiconductor and AI sector.
And the impact on the market is clear.
Oh, absolutely. The broader tech stocks, look at QQQM, near $252 to $254. They're so sensitive to this.
Yeah.
And you can see capital pulling back to safety,
Yeah.
to short-term debt, money market funds. People are risking until this H200 question is settled.
Now, NVIDIA has the geopolitical risk, but what about the other big AI players? Meta, Alphabet, how are they doing?
Well, Meta, trading near $658, is all about its AI advertising pipeline. The market is just watching to see how fast they can turn AI investment into real ad performance.
And Alphabet.
For Alphabet,
Yeah.
you're $307, $310. It's that triumvirate of advertising demand, AI commercialization, think search, cloud, and of course the ever-present regulatory concerns.
So for tech, AI is still the engine, but regulation is the friction, whether it's export controls for NVIDIA or antitrust for the others.
Precisely. Regulation is the unexpected tax on growth right now.
Okay, let's pivot from Silicon Valley and the Fed to the highly leveraged 2047 world of digital assets. The caution we see everywhere else seems almost amplified in crypto.
It does. I mean, you just have to look at the data. The crypto fear and greed index is deep in the extreme fear range. It's in the low 20s.
And that's not just a quirky indicator, is it? It points to market structure.
It really does. When sentiment is this low, it usually means leverage is high and concentrated. And that means the market is incredibly vulnerable to liquidation cascades. A small dip can force leverage selling, which causes a bigger dip, and so on.
So fear literally breeds more volatility. What are the key levels you're watching?
Bitcoin, or BTC, is around $88,800. It's been oscillating between, say, 85K and 90K. Its stability is really being tested.
And Ethereum.
Ethereum, ETH, is recovering near the $3,000 mark.
Yeah.
For ETH, it's all about the derivatives market and on-chain liquidity right now. Can big players get in and out smoothly?
We also need to talk about the really speculative corners of the market. Our sources flagged these with bright red warning lights.
Yes, specifically assets being called HYPE. These are your small high beta tokens, and this new sector called pre-stocks.
Pre-stocks. That sounds inherently risky.
It is. Think of it like buying shares in a private company, like Anthropic or XAI, but through a token on a platform like Solana. The beta is extremely high, and the contract and custody risk is significant. You aren't buying the stock, you're buying a token that represents it.
So what's the single most important thing for anyone looking at these?
Verification. Verify the contract, verify the custodian, understand the tokenomics. The risk here is just orders of magnitude higher than holding Bitcoin, mostly because of operational and smart contract risk.
It's important, though, to contrast all that volatility with the quiet institutional moves happening in the background.
That's the long-term story. Look at Circle, the issuer of USDC. They just got a financial services license in Abu Dhabi. That's a huge step for compliance in the Middle East.
And Coinbase is making similar moves in India.
Right. They've restarted registrations there, planning a local fiat channel in 2026. These are multi-year plays. It shows that institutionalization is moving forward, regardless of the daily price chaos.
Which brings us full circle. We've got the RMP liquidity signal, the NVDA event risk, and the crypto leverage. So let's summarize the strategy. What should you be doing in this market?
I think the #1 priority has to be risk control, capital preservation. The market is defined by this cautious Fed liquidity signal, combined with waiting for that NVDA news and the vulnerability in crypto.
So step 1, retain liquidity.
Yes, use phase buying for broad indices like VOO and QQQM.
Yeah.
You want to have cash ready to buy on any pullbacks.
And for NVIDIA, We wait for certainty, not just hope.
Exactly. I would only add to positions if those H200 approvals actually materialize without crippling restrictions. And if the news is bad, you need strict stop losses in place.
And in crypto, the mantra is small, safe, and unleveraged.
Maintain only small, very cautious exposure to Bitcoin and Ethereum. Avoid high leverage completely. And those assets like HYPE and pre-SOX, avoid them, or limit it to a tiny, tiny speculative allocation you are fully prepared to lose.
This has been a really necessary breakdown of where the market's focus is right now. We started with the Fed's technical tools and ended with geopolitical drama.
Before we go, here's a provocative thought to mull over. There's this ongoing debate about RMP. Is it truly just technical reserve replenishment? Housekeeping, like the Fed says.
Or is something else?
Or is it effectively a subtle form of quasi-balance sheet expansion? A sort of stealth easing.
That's a huge distinction, technical versus quasi-expansion.
It is. So the question is, if the market over the next few quarters definitively decides it's the latter, that it is a subtle form of easing, what impact could that have on longer-term Treasury yields? Does it reset inflation expectations? That interpretive decision could reshape the entire rate environment.
A fascinating and very high-stakes question to carry into the next news cycle. Thank you for joining us on the Deep Dive. We hope you feel ready to navigate a market driven by both technical liquidity and huge event risk.
Always a pleasure. We'll catch you on the next one.